So private sector banks, especially the large cap ones, we like them. But I would want to caution here that these banks who say 5 years back were growing at 20%, we have reduced our expectation to say a 15% earnings growth on a compounded basis over the next 3-4 years. They no longer are the 20% compounding because they are large. I mean, say the largest private sector bank has a loan book of 30 lakh crores. So they are no longer small. So if you have a slightly lower expectation on their profit growth for the next few years, then you could make returns in some of these. Whether they get re-rated from here, that's a big question mark. They already got de-rated for last 3-4 years. So we are expecting that even if they don't get re-rated, they could give you whatever 15% return over the next few years. So we are more bullish on the larger banks than on the smaller banks, because smaller banks have tended to move or their exposure to the unsecured, to the MFI segment is far larger than the large cap banks. I still remain bearish on the microfinance part of the book. So look at the overall segment. It's about 5 lakh crores is the rough book size. And if you look at the last 6-7 years, and this has been the reason why I was very bearish, that the customer growth was only 3-4%, and the loan growth was about 20-22%, which basically sort of told me that you're not getting new customers, you're continuing to give loan to the same lady more and more. And there's one more incremental data that the non-MFI loan of these customers is about 1 lakh crore. So they have not only taken microfinance loans, they have also borrowed the non-microfinance, which is unsecured or a auto loan or some other loan. That itself is another 1 lakh crore. So I think this will take some time to clean up. In my view, that they are broadly penetrated. The microfinance has broadly penetrated. And from here, it's very difficult, which is why you're not seeing the customer growth. It's going to be very difficult for this segment to continue growing. I think the ills of the past, which is when you give 5 or 6 loans, in some cases 10 loans to the same lady, and I really don't know how this happened, because you have a credit rating bureau which has all the details. Why would you go and give the 7th, 8th, 9th and 10th loan to the same lady? I still don't have.
Figure out which is the 5th and the 6th and the 7th.
We did get some names, and a lot of them were these online lending, but there were some large NBFCs also in that. But the question is, why would you want to do it? Because you're basically putting all the others also at risk. And I'm surprised that RBI has focused so much on the gold loan and that's a secured lending book.
Yes.
I mean, what can you lose in that?
There is price risk, but even then.
But in this case, you have everything at risk. But they seem to have let this go, and their focus, even for the last 3-4 years, they've been so focused on the gold loan, whereas they've just allowed this to go without much of regulation. I think there needs to be regulation here, because if people are lending so many loans to a lady in the microfinance segment, then that's a serious risk. So that's how I would put it.
You see that as a risk even for NBFCs, because in the end...
Yeah, I see that a risk for the sector, because everybody is in... So take an example that I did everything correct. I lent to a lady based on her credit rating or whatever, and you were the first or the second lender. But then if 5 or 6 more people come and lend to her, you can't do anything because you've already given the loan. I think that is the risk, that the industry is not disciplined. So this is a self-inflicted wound. Unlike the past, microfinance troubles have come because of external events. This is a trouble that has come because of the industry indiscipline. So I think that will cause more pain. And just keep in mind that these were yielding 24-25%. The NIMs were very good. So when I see banks coming and saying X MFI, I'm this, X MFI, I'm Y, I said, my point is that when you were getting the higher NIMs, you never told us that please remove the MFI because my extra NIM is because of the MFI yield. So I think the pain is not over. Even if they stop lending, their NIMs will come down. So I'll be very careful with NBFCs, smaller NBFCs, the niche ones who have unsecured lending
Right.
in their portfolio. The larger ones look far better.
Okay. But in the larger ones, how do you see credit growth? Because that has come down sharply last year. There is, of course, one thing that has played out is this huge liquidity injection. I think this recent rally is largely because of that. Do you see growth panning out this year in this environment?
I think the credit growth will be in the 12-13% range. So which is why I said that we have sort of moderated our growth expectations for the bank to say between around 15% profit growth. So if they get operating efficiency, they can show slightly higher profit growth than the loan growth. We think loan growth will be in that range because your largest growth for the loans were coming from the retail lending.
Right.
Corporate still not borrowing. I don't
Correct.
see that changing in a hurry. Maybe if the dust settles down after the tariff and there's more demand, but that's at least 12 to 18 months away from today. So that's
So-
how I would see that growth. I don't see growth.
So you're saying a 12% growth in credit. What is your thought on deposits? I'm just trying to figure out in the next 1 year, because they've gone up so much already. From today, if we see 12 months out, are these stocks going to deliver?
Yeah, so it's very difficult. So keep in mind that these stocks didn't deliver for 5 years.
Yeah.
Okay, so we are seeing some sort of. Also keep in mind that my broad view is an uncertain market for the next 12 months. So in those sort of circumstances, if you get stocks which can sort of give you a 12 to 15% earnings growth, and downside is not that much because they hardly participated.
Right.
So these look safer right now. As I
Right.
said that at different times, based on different market conditions, you try to position your portfolio. At this stage, these look far safer because the uncertainties are far lesser. At least you have a central bank who's slightly in your favor right now.
Right.
Liquidity was the biggest concern if you spoke to any banker 6 months back.
Correct.
And I think they have addressed that, substantially.
Yes.
Also, if I look at the way inflation has panned out, I think I've been an inflation hawk for a long time. I think that inflation will surprise on the downside. Coming from an inflation hawk, that is a big statement. That RBI itself, the RBI numbers will surprise us that the actual numbers could be 50 basis points lower than what RBI has suggested. So we have.
Why do you think so? But
Because of
Where are you seeing?
the last 3 inflation prints, look at the last number. We got almost 3.3 as the headline CPI inflation. Food
Yeah.
inflation has really come off.
correct.
Even if I, for a second, assume that food inflation were to go back slightly up, our base effect will ensure that we'll be below 4 for the next 3-4 months. So RBI has the leeway to cut 50 basis points, in my view, in the next policy because they'll have prints which will be constantly coming below the 4% mark.
Right.
So you
that at
could
least
have-
creates a support.
Yeah, that's what I'm saying. That it creates a support for a conducive banking environment
Right.
with lower rates. Yeah, it could have an impact on NIMs, but you could have higher demand for loans also. So that's how I would look at the macro for the banking sector, and I would say that the large cap, both private and maybe a few large cap PSU banks also I would throw into this. They look reasonably fine.
News18.com marches way ahead of the Times of India with 38% more users on native and social platforms. Network 18, the undisputed leader of news networks, way ahead of the Times.